Liz Young-Thomas is with us, head of investment strategy at SoFi. I knew that. How are you? Good morning.
I'm good. Hi, Joe.
We had a great run-up to the easing cycle. Does it continue, or is it like so many things where we've already anticipated it and already traded on it, and now the going gets a little tougher? What do you think, Liz?
I think the biggest gains leading up to the easing cycle have probably been had, but that doesn't mean it slows down necessarily in the immediate term. So usually after that first cut, when you look out 30 to 60 days, the market is flat-ish to up, and then about 3 months out is when the market decides whether or not these cuts were needed because things were cooling too quickly, or if they were cuts because we could do it, not because we had to do it, in which case the market ends up being much more positive. So there's a few other things going on, though, that obviously are a tailwind for this rally. We've seen tech give a little bit back, or at least slow down its gains and not be leading the market as much, which you would think is a negative. But what we've seen also is that a lot of other stocks are coming up and really pulling their weight. And with 80% of the S&P still trading above its 200-day moving average, there's a lot of internal strength behind the rally, not to mention the optimism over China stimulus. So I think in the near term, we've got a lot of good things going for the market.
It seems like valuation concerns, it never helps you really with the timing of when to lighten up, although, watching what Warren Buffett does can help you sometimes. And we've already seen maybe him lightening up a little. But the reason you like rates to come down is because multiples can expand. But in the United States, aren't we at about 21 or 22 already? Why should unless it spawns more higher earnings, it seems like multiples are already pretty rich.
I would agree. Multiples are definitely rich. If we compare it back to what we do most often right now in the early 2000s, not nearly as rich as they were then. But when you look at where we are today, we're above the 5-year average, we're above the 10-year average. We're not quite at overbought conditions on the S&P, but we're up there. And when you talk about Warren Buffett, he's the longest of long-term investors, so he's obviously not trying to time the multiples on markets. But what you do want to see from this point forward, if we are able to secure a soft landing, you want to see the market start to trade more on fundamentals and not on multiple expansion, which might actually mean mathematically that multiples don't expand that much more from here, but earnings get more steady and stable. And you see some of the other sectors besides tech come in and show some more earnings strength. So we've seen little glimmers of that. We've got obviously a lot of strength in the industrial stocks right now, but not so much strength in financials. So there's still some conflicting signals from the market, but we don't necessarily need it to be multiple expansion. You do want to see fundamental expansion as well.
Well, that's it. Then it seems like you really got to do some homework and research, because it's not going to be like a tops-down move in the markets. You're going to have to look for the companies that are benefiting and posting better earnings gains over this. Who does that include? And do you have to think about the election? Do you have to think about what goes into deciding which sectors are going to have faster earnings growth?
Yeah, well, the other thing you want to keep in mind is if stocks expand just on multiples, they can give it back very, very quickly. And frequently, if it's mostly multiple expansion, when you do have those little bouts of volatility, the ones that have run the fastest go down the fastest as well. So it leads to more volatility in the short term. So who can benefit? If tech continues to give some of this back and not lead the pack, what I think investors are going to start to do is look for growth in other places, especially as U.S. GDP growth has slowed down a bit, still stable, but has slowed down a bit. So where can you find that, and what kind of environment are we in, and what sectors would do well in that environment? And the one that continues to bubble to the top for me is healthcare. You can find growth still in biotech and pharma. Healthcare is traditionally a defensive sector, but tends to do well in environments where the yield curve is steepening, particularly a bull steepening environment, which we have been in for a while. So you want to look at healthcare. The other thing is, I would say, when everybody is so certain of an outcome, you want to make sure that you're still considering the possibility that it doesn't happen. And right now it seems like the market, the Fed are very certain that we've hit soft landing. So what would you want to hold just in case that doesn't come to fruition? I think you can take advantage of some of the rise in yields in the 10-year, but you still want to look across the Treasury curve from the 10-year down and look at the short end of the curve and find some opportunity there just in case the Fed has to cut faster than we expect.